What's up, everyone? What's up? Good evening, everyone. Can you guys hear me? Like, if you guys can hear me, please give me a yes. No, I just want to check. My sounds is loud and clear. Yeah, all right. Yeah, yeah. Thanks, everyone. Thanks, everyone. Thank you for joining. Then, I think today's section is going to be what I think to be the is chapter 7. Is it? Yeah. We still have three chapter to go. Three chapter to go. Oh, you guys, like, do you guys made some profit from the last week? It's curious. Yeah, yeah, there we go. We have the option hunter with us. Yeah, chapter 7. Good evening, everyone. Good evening. We are going to start at 8 o'clock, so that before that, so we could have a little bit of chit chat, like those kind of. So it's to see how you guys been doing so recently. Hi, Rosum. Hi, hi, hi. It's been a week, huh? It's been a week. How are you recently? Very good. Like recently, everything was okay. I hope you guys do capture some of the profit last week. Okay, but slow. Yeah, yeah, yeah. I mean, like, slow is fine. It's fine. Don't force yourself. You just have to, like, go with your pace. Hmm. Oh, hi, Scorpio. Good evening. Good evening. How are you, Scorpio? Yeah, he's been with us for so long already. It's like Scorpio. Yeah. Yeah, because like option hunter asking the right questions, like have you guys like applies what you have learned like throughout the whole sections? Hope you guys do learn some things like during all like along the journey. Still catching up. Yeah, yeah, yeah. No, no worries. Because like still doing spread, would like to try spread. Yeah, yeah. We're doing spread today. We're doing spread. No worries. I guess you guys have been waiting for spread things, right? Like you guys have been bored with the single leg things. So like we because into this sections is already a chapter 7. So that as I promised you guys there will be a 10 chapter of it. So I think there will be three more chapter, I guess. Like debit spread, controls. Yeah, three more chapters to go. Yeah. So after three chapters, and then everything's will be just wrap ups, like just done. So that after the whole option playbook series, I do hopes like you guys can handle the options uh, in a very good way. Still need to rewatch some of the videos. Yeah, yeah, yeah. Because the video is always there, Like the video is always there. Like you just have to like understand the foundations of it deeply, so that you along the ways, when you see those kind of spread, you roughly knows like how it actually works. You know, after the chapter tens, I don't think it's like I'm not sure whether I'm still doing this. Doing live things. Then, but yeah, if I'm not doing it, and then maybe you guys can watch the Alvin series. Alvin has been sharing some of the strategies, some of the tools you guys can how you actually use those kind of features to apply on the markets. So yeah, just wondering after the whole option playbook series, what you guys still want to learn. You know, just curious. No promises, but like maybe some of the series Elwin could cover it up. Just wondering. You mentions many times skills and weeks. Yes. Skill and weeks. Which kind of a skill you are mentioning? VIX, I think is everybody will be understanding it already because like it's just simply the S&P option fear index. We are going to start in the 2 minutes. The sessions will be start at 8 o'clock, so that we meanwhile will be waiting for others to actually join, so that you know. So we still have 1 minute left, and then we will be start at 8 o'clock. Oh, do you means like you want to learn about skill and fix those kind of things? Like, because I think the definitions of it is already been clear, right? Mm. There's no reply from me. So yeah, I guess I'll be starting the section. So, okay, it's already 8 o'clock, so that we will be just start the sections. And if you guys do ready, please type one. So let me know that you guys are ready to go. So I'll be starting the sections. No, I just one further. Okay, so yeah, let's start the section. So into today's sections, like as you guys can see, from the titles, like you could actually generate things incomes without owning the stock. Okay, so like we have gone through a lots of the single leg things, right? Like a cash secure put, and then the cover call, and the and also we also cover some of the things that how you actually combine with your cash and your stock to play around. And in today's sessions, this is the first spread that we will be introducing to you guys, because like I think I think it's important for us to have the foundations strong first before we going into this kind of a chapter. But I guess you guys do. So like let's start the sessions. Before that, we of course we will have the disclaimer as well. Like remembers that option trading entails a significant risk. It may be not appropriate for all of the people, so that be aware of that. Make sure you read the disclaimer, understand what is the options, the disclaimer all about, so that once we have that, keep have that in mind, so that we start. So as in today's session, actually, I'm going to teach you guys the first spread is called credit spread. Okay, have you guys heard of credit spread? If let's say yes, please type one. Have you guys heard of credit spread? Just wondering. Yeah, credit spread. Okay, okay, okay. You guys have heard of credit spread? Actually, it's like a credit spread, just a two-leg things. Okay, it's a two-leg things. Later I'll show you how it works. Actually, most of the times, right, when beginners tap into the market, they tends to like generating incomes through single leg. Okay, through single legs. So they will what they do if they are bullish, they will just sell a put, a single leg put, so that they collect the premium. They expect the price won't break through the strike price. If let's say they are bearish, they will just sell a single leg of the call options. But the problem is what? The problem is that the only management they can do if the direction didn't end up well, it go against them. So what they do, they would just roll their positions, right? That's the only things that they can do. Rolling the position means that you're closing your current position, you take the losses, and then you open up another position that is further out of the further from the choose a further expirations. That's what all about. But it is the unlimited risk is real, because like if it go against you, you have no idea how much you will be losing, right? The problem is here is that the unlimited risk. So that this is why some of the people to create this thing is called spread. Okay, so when you think of spreads, right, you need to think of like a risk management business. Okay, it's like an insurance. Of course, like if you're doing a cash secure put, you are expected to be taking the stock. What if you don't want to take a stock? Okay, so you actually can buy another leg actually to hedge with it. So basically, it's you are collecting the premium while doing some insurance. Okay, so the first thing first is that you, of course, if you want to generate some incomes, right? What we do, we sell the options, right? We shop the options, so that the first thing first, we will have what? We will have generating the incomes, right? Okay, we will be generating incomes. So remember, the first thing we do is always sell the option first. Okay, regardless of any call or put. Later I'll tell you about the directions, but just remember that your incomes will be based on your short leg. Okay, and then we long another options to cap the downside. Okay, we long another option to cap the downside, because like if let's say the price go against you, you still have another leg to limit the risk. Okay, so that this is what? This is your insurance. This is your insurance. Okay, and then this is your profit driver. This is your profit driver, so that your profit driver, the money that you collect, can it be lower than what you have paid for the insurance? Can anyone answer me on the chat box? This is your income. This is what you pay for the insurance. So that the income must bigger than what you have paid, or like lesser than what you have paid. Can anyone's like answer in the chat box? The income driver has to be more than what you paid, or lower than what you paid. Bigger income. Yes. Exactly. So that the income must be more than what you have paid, so that when it net off, both options expire, you collect your income. Okay, you collect your profit. That's how it works. So that you have to make sure that you're collecting more premiums than what you have paid, so that eventually if both options expire, you get your remaining income. Okay, that's how you actually define your risk. You have a definitive max profit and your losses. Okay, so what actually we are trying to solve, because like in credit spread compared to the cash secure put, or maybe even like naked option seller, what is the difference between them? Because like the first thing first, of course, is the capital trap. Remembers like the first spreads that we have learned, like we have the stock together with the sell call, right? And also the cash, the cash and the sell put. Because when the price, if it hits below the put strike, then we buy the stock. But because we are planned to buy the stock, so that we need to have what, a large amount of the capital in our accounts, right? Because we are expecting to be getting the stock if, let's say, it hits below our strike price. So the capital, it can be quite intense. Okay, the capital can be quite intense. And also, if let's say if a flash crash already, if let's say our plan doesn't, we just want to collect the premium and we don't want to take the stock, out of a sudden the stock dropped 30%, you end up will be losing like 10,000 over losses. This is that kind of a things, like it can be a nightmare for you, because like you didn't plan for losing this much. Because remember, like if you're doing a naked of option position, your risk is basically unlimited. Okay, but if let's say it goes sideways, and then or maybe it goes with your direction, you call it the full premium. Okay, but in order for us to actually collect this premium, we actually carrying a large risk. Okay, larger risk. Okay, so what we actually can do, so we can do a credit spread. Okay, because like credit spread, you can limit your losses. Okay, and also because it's a spread, so usually the buying power to entry into this kind of trade to collect the premium usually is relatively lower, because you are not planning to take the stocks, right? So that you actually, if you, let's say you have two legs, usually the buying power is it will be very low. Okay, so it will be very suitable for those who does didn't plan for taking the underlying stock into their position, but just simply want to collect the premium for the sake of the premium. Okay. Also, they want to define their risk. If let's say the stock dropped 30%, no matter how deep it drops, you eventually will be having a max loss. It will be capped. It will be capped. Okay. All right. And also, um, the ROI is quite high. Says, for example, if let's say the stock went sideways, you initially be your spread collecting 150 net premiums. The advantage is that it moves like because of the initial capital is very low. Sometimes you can get like 42% per trade, like sometimes 30%, sometimes like 60% per trade. These kind of things. Okay. So, do you guys understand this part? If let's say understand, can you let me know? It's like you're okay with it. Type one if you understand what so far. Okay, the difference between the naked options and the credit spread. Okay, okay, right. So once we have understand all the features or all these things already, right? So we will getting into the, as usual, we will getting into these things. So who should actually consider this strategy? So for those who actually they have a relatively small account sizes, they didn't have a sufficient amount of the amounts to want to collect the incomes, they actually can do this strategy. Okay. And then also the risk profile is kind of like a moderate, because like you still need to bet on the directions. Okay, you still need to bet on the direction, and also like your risk is capped, so that is, I would say, is considered, the risk profile is considered moderate. And also you want to like generating a recurring incomes. Okay, recurring incomes are based on the probability things. Okay, it's not like you always betting on the directions. You also can actually betting on the probabilities to actually generating income. Okay, this is your main objective, I guess. Okay, and the best part is that it can be like short to medium terms. Okay, some of the people they generating do the credit spreads on the shorter terms like 0 to 7 days. Like that's what Elwin love to do, like 0 to 7 days. And then some of them is like love to do like 30 days, 45 days, and then allowing the options to getting into the 21 days so that the option decay very fast, those kind of things. Okay. Like me myself, it depends on my strategy as well. I have short, I have mid terms, I even have a long terms uh credit spread ongoing as well. Okay, it depends on your strategy. But if let's say eventually you guys want to learn how to actually do the long term things and generating um a very safe income, you let me know. Okay, but that one will be in the futures. Okay, so when to use this strategy? Okay, so basically in credit spread, right, we have two things. One is like the bull put spread. Okay, bull put spread. And then basically, if let's say we are doing a bull put spread, our directions will be neutral to bullish. Okay, it can went sideways. We can profit from the sideways. Also profit from when the stock price went up. Okay, so basically it means what? Like says for example, if let's say I'm selling, if let's say the S&P is 600 now, and I think based on my analysis, there is a very strong support, or maybe there is a very strong volume profile at that level, at that 590 levels. I think it won't break below this level. So what I do is that I will be selling 590. 590. Okay. At the same time, I will be buying the next options with, which is the 585. This is what we call the $5 width. Okay, $5 width. So this long leg is mainly for protections. Okay, so if let's say the S&P went sideways, like 601, like 592, 595, went sideways or even go up, after the expirations, both options expired, I get to collect the premium. Okay, so this is how it works. If you think if you're doing the bull put spread, you need to think that your income driver, your leg is won't be dropped below that level. Okay, this is how you think. Okay, so far so good. If let's say can follow, then type 1. I want to make sure you guys understand the concept. When you're doing a bull put spread, your direction is neutral to bullish. Okay, and you thinking your mind should be thinking the price won't fall below that level. It just same as the cash secure put. Okay, so yeah. Second, let me do some. Okay, so another thing is that the bear call spread. Okay, bear call spread basically is the other side. Right? Okay, inversely the other side. Okay, bear call spread means that is neutral. The market can went sideways to bearish. Okay, which means that you are what? You can profit from these two directions. You only lose money when the market goes up. Okay, so the view is that you need to think the asset has hit the ceilings already. Okay, it won't rise above it. Okay, it won't rise above it. Okay, say for example, S&P now is like 600. You think that it won't rise above 610. Okay, you think it will rise above the 610. So what you do, you sell a 610 to collect the income, and you buy a higher strike for protections. Okay, so that's how you actually do it. It's just the same concept. One is you betting it won't rise above that level. One is that you betting it won't break below that level. Okay, so far so good. Type 1 if you understand what I'm saying. Okay, because it's very important, like to understand which spread you are doing. Okay. Okay. So I see one. Okay. All right. Let's move on. So why this strategy works? Of course, like traditionally, if let's say we are long the strategy, we need to like predict the markets, right? We need to like have a higher. Actually, can't say the predict. We need to have some directional outlook. So like market can go where market can actually like go up. It went sideways and goes down, right? There will be three directions the market can goes. Okay, so 100% of the directions will be up, sideways, and down. So that if let's say we are doing a spread, a credit spread, it can profit from where? It can profit from neutral to bearish. And this one, if let's say we are doing a bull put spread, we are neutral to bullish, so that we have two directions we can profit from, right? So out of the 100% of the directions, like three directions, 33, 33, 33, there are two directions we could be profiting from, right? So that basically from direction perspective, we actually have 66% of the probabilities to win, to collect the income in the markets, right? You know, there's only 33% of the probability it will go against us. So that this strategy works because of the probability. You can actually you can actually using this probability concept to actually generating income. Say for example, if let's say you long a strategy, let's say you buy a call, you're bullish. If the stock price rally, you win. Of course, your ROI could be very high. Okay, your risk and reward can be very high. But if let's say it went sideways, your options starting to decay. Eventually, you lose. If let's say the market drops, eventually you lose as well. Okay, and even you lose faster. But if let's say for credit spread, okay, we use bull put. Okay, bull put spread. If the stock went rally, we option expire worthless, we win. The market went sideways. Okay, the option gradually depreciate. Eventually, we win. If it drops slightly, we also win. Only when the market really drops below our strike price, then we only lose money. Okay, so based on the directional perspective, we're actually having the higher probability to actually do the credit spread, like 66% of the probability. While like if let's say you just long call, there's 33% of the probability. Sometimes this can add up to 80%. Okay, if let's say your contacts, the range between your under current prices and your strike price is very far, it can goes up to 80%. Okay, so that this is why like this strategy works when you have a probability sense in your edge. Okay, so and then also another reason is that if we are just doing a sell put, like sell put, we are expecting the bullish. We sell put. If let's say the underlying crash to 500, okay, we will be losing what? We will be losing around 10,000. But if let's say we are doing a credit spread, we sell a 600 put, we buy a 90 put, a $10 white, and then if let's say it crash already, no matter how deep it crash, we will be still only losing 1,000. Okay, we will be still be losing only 1,000. Okay, and minus your premiums. Okay, because this is the spread, right? 600 minus 590, the $10 white. Multiply 100, then we get 1,000. But because we got collect premium, so we have to minus the premium. That one will be only consider our max loss. Okay, so that's the whole ideas why this strategy works. Okay, if let's say you guys can catch up, please tap one. Okay, you guys tap one. If let's say you guys can follow why some people love to do the credit spread. Okay, because of the directions edge, and also because of these defined risks. So if let's say you are going to do collecting the income, and then collecting the income also like you don't want to take the stock, it's best for you to actually do a credit spread. You know? Okay. So how do we actually trade these things? First of all, we cannot live without outlooks, right? Because like we need to we have two types of a strategy. One is the bull put spread, another one is the bear call spread. So that we need to have a direction first, so that the success of this trade, it will always start with selecting the high liquid stock or ETF. Okay, and then we need to use a lot of those analysis thesis to actually uh, conduct our analysis to generate an outlook. Like fundamentals, you look for like a stable and very predictable in earnings. Okay, those kind of fundamental analysis valuations. You can use this method, and also you can use the technicals to identify where is your support, where is your resistance, and then to define your short strike. Also, you also can use the macro as well to actually like identify whether the current environment is it bullish or bearish. And the most important part is always the liquidity. Okay, it's always the liquidity. If let's say your spread is very wide, sometimes your short leg you collect the incomes already, but when you want to long your long legs, right? Because your spread is very wide, sometimes it can get more expensive, very expensive, and then it is even more than what you have collect. So that liquidity is very important, Liquidity is very important. So you don't when you collect the income, for example, at $100 already, then you have to look at your next protections strike, whether is your spread is it tight enough or like it's very wide. If let's say it's very wide, some like $0 to $1, then you're collecting 80 cents. So you are paying $1 for protections, and then you're collecting 80 cents only. Eventually, you become a debit spread already, but actually you are doing a credit spread. So that makes sure that your bid ask spread is very tight. Okay. And then once we have those directions ready, so that we can actually choose our strike. If let's say we are bullish to neutrals, then we do this strategy, bull put spread. If let's say we are bearish and neutrals, we'll be doing a bear call spread. Okay. So, and then the third one always is selecting the expirations. Like typically, remember the option curve. Do you guys still remember the option curve from 90 days to 60 days, 30 days, then 0? Do you guys still remember that? Okay. The shorter the time it is, the faster the option decays, right? Okay. The faster the option decay. So like from the expirations, I think it's like typically they will just go for 30 to 45 days because 30 days is the data tends to accelerate so that they get to collect the premium much more faster. Okay. So if let's say the price but be mindful because like 30 to 30 to 45 days, that's about a month. You need to expect the price doesn't break above or break below that level because price can have more time to travel to that your strike price. So they have to be aware that the more time you have, the further expiration you choose, the more time the price could be traveled to your level. You have to make sure that it below or above your level. Okay? So that it all depends on your strategy here. Because with all this analysis, I think you can get the rough idea how long is your expiration want to be picked up at. You know? So if let's say you guys can understand, can you guys type one? So far so good. Because you guys already have the foundation, so that I don't have to like keep on explaining the basic things all over again. You know? All right. Okay. So let's move on. Okay. So now choosing the strike. Okay. Just now I already mentioned one examples, right? You can actually use the technical support and resistance to define your strike. If let's say your things that it won't break above 600, then you sell on strike price at 600. Then you buy another one, a lower strike. If let's say you think is that it won't break below that level, then you do a backward spread. Then you pick that level. Okay. The second approach is that usually what the option traders will do, they will just sell the short strike around by using the delta. How much delta usually will be 15 to 30. Okay. Remember, I got mentions to you guys that what is a delta means. Like if let's say 0.30 delta, which means that there will be only 30% of the probability the options will go into the money. Will be going in the money. Okay, 30% of the probability. But it will be theoretical. This one because it's a theoretical thesis. But we use it as a reference as well. 30% doesn't mean that it won't go into in the money because like things can happen like gap and suddenly out of a sudden got some news. The delta can change. Okay, it's not a static thing. But option trader use the delta as a reference as well. So like say for example, if I sell a 30 delta, even though it's called 0.3 delta, we call it 30 delta. Okay, this is our jargon. If we sell a 30 delta, which means that based on the current market implied volatility, it assumes that there will be 70% of the probability the options will be going in the money. That's what all about. If we're selling a 20 delta, then approximately mathematically, we have 80% of the probability the price won't move in the money. Okay. Because credit spread, we want to collect the premium. So that we want the option expire in the money or out of the money. Can anyone tell me? In the money or out of the money? Please type in the chat box so that I know that you guys are following. Okay. Yes. Out of the money. Yes. Because like we want the options expire worthless. So that we want the option have a higher probability that staying out of the money, not in the money. Okay. So that we could collect the premium. The third thing is the spread width. Okay. Some is like you will realize that the strike price like a $5 strike. I think for SPX is like minimum is like $5. Some is like $10. Some is like SPY is like $1 width. So you actually can adjust accordingly based on your max loss and win rate. And if let's say you want to collect more premium, you can do a wider spread. But later I'll tell you like what is the cons of it for by doing these wider spreads things. Okay, so that is very flexible. It's very flexible. Okay, and also like you can actually target your returns as well. For example, it's like some of them is like you collecting 30% of the premium, then you're okay with it, then you open another spread. Some is like 50%, some is like 60%, some they die want to like hold it after the expiration to collect the full premium. It entirely depends on your strategy. Okay, it entirely depends on your strategy. But the fourth one is the most that I don't recommend because like you are just targeting the premium. Sometimes because you want to you want to collect this much of premium, it may it may it may doesn't align with your thesis one. So then be mindful that if let's say you are aiming for the absolute value of the premium, because the strike you chose may not be ideal and align with your thesis. My 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 takes is that you have to always align with your thesis because this is not your thesis. This is just like the returns perspective. Okay. So what you do is like you press one leg to sell at your delta level or your support, and another one you just buy out further out of the money to define the width, which is this one. I'll show you guys how to do it later. Okay, don't worry because I just want you to understand when you are doing the credit spread, what you should consider, what you should put it in mind when you're looking at the option chain. Okay. And after that, you just execute. And then the most important things when you do spread, okay, when you do spread, you must always visualize the curve. Okay, you must always visualize your curve by the expiration. Do you actually make money? If let's say the price landed at your target prices, okay. So always use the curve to actually see your P&L. And then once you enter into the position already, there will be only two outcomes if you hold until the expirations. Okay, one is like either you take the max loss or you fully collected your premium. Sometimes if let's say it moved to your target prices already, but the premiums still haven't captured 100%. Okay, like 50 to 60%. Some they will just like close their position. Okay, if let's say they assume there will be a reversal or some things, okay, some they will just like close their position. If let's say you want to hold it until expiration, you think that it won't break your strike price level, you feel free to actually capture the 100% profit. Okay, if you're asking me which one I do the most, usually I have various of the strategy. Depends. It really depends. Okay. But if you're asking me, because I heavily rely on this thing, especially quantify strategy, I usually like close based on the thesis one, which is this one. Okay, unless that the strategy is just like very systematic mechanicals like iron condos, like keep on collecting the incomes for every certain days to certain days. Okay, then I will let it expire worthless. Okay, so yeah, then losing one, you're just losing because both leg in the money. They you just like have to manage the position by closing it, or like you let it expire worthless. Then you see like your let it contra each other. Sometimes if let's say it doesn't contra, like your short leg got assigned earlier, then you just exercise your long leg to actually like close your underlying position. Okay, you guys understand what I'm saying, right? Because like you got two leg. You got two leg. If let's say both leg, if you're in the losing scenario, both leg went in the money already. Your short leg got assigned. Say for example, if let's say you're doing a bear put, your put will be buying the underlyings already, so that you have a stock in your portfolio. Then if your long leg still there is in the money, what you actually can do is that you actually can exercise your long leg. You plus 100 here, then you this one, if you exercise the put, then is minus 100 so that you contract each other. So that it become defined risk eventually. Okay? So that's how you actually do it. So what is the examples? Like example A is that the bull put spread. So bull put spread, we are expecting what? Bullish to neutral, right? If let's say you guys want to like decode the names of it, whether this spread is a bull or bear, you just look at the first word. Some they put it a long put spread, those kind of things, right? But if usually I would just prefer to read it like a bull put spread. If let's say we are bull here, then we are expecting the price to bullish or neutral to be profiting. But we in the view of we're expecting the price won't break below the certain levels. So like in this example, because we are doing a bull put spread, so that we are neutral to bullish. So if let's say we are betting the SPY won't break below 590, so that we actually can sell 590 put. Then during the time, maybe the put is like $500. Okay, so that we collect 500. Then we go to the next the next strike, higher the lower strike, then 585. Then we buy this put as a protection. So we pay 350. So we collect 500, we pay 350, so that our spread is 150, 1.5, $1.05. So that our max profit will be 150. Okay, our weight is how much? Like this one minus this one is like $5 weight. The requirement usually is your basically is the spread between your strike or your max loss one. Okay, your max risk loss, how do you actually calculate the max loss? Okay, 590, because you sell a put. Okay, I want you guys to actually listen carefully here. You sell a put, which means that at the end of the day, if let's say this leg is in the money, your obligation is to buy. So if you're buying the stock, you buy at what price? You buy at 590. And then because you want to define your risk, this leg also in the money, then you exercise this leg. If you exercise a long put, your right is what? Is to sell, right? Because you buy put, your right is to sell. So you buy at 590 already. Then you exercise this, then you sell at 585. You're losing $5, right? Times 100, then you're losing $500. Okay, is this your max loss? No. You buy at here, you minus here, you're losing 500 from this spread. But remember that because you did a spread, you're collecting your premium also will be collected. So that 500 minus 150, your max loss will be 350. Basically, that's your cost. Okay, basically that's your cost. That's your cost and also your max risk. Okay. And then if let's say you want to calculate the return on ROI, usually is like around like 42% from this trade. Okay. So this is how the spread actually works. You buy at eventually if you sell a put, you're obligated to buy, you buy at this price. Then you sell. Eventually you exercise this one, you sell at this price. And then, but remember that you also collected a premium so that your max loss is, no matter how, it's just 350. Okay. So just now I already mentioned that this is the loss part, the scenario B, because like both leg in the money, then it actually falls under the loss part. If let's say the price crashed to 550, both leg actually in the money already. So eventually, if let's say you didn't get assigned early, after expiration, you're obligated to buy at 590, but you exercise to sell at 585. You lose 500, then you minus the credit you collected. The total loss will be 350. So your loss is defined. But what if the price eventually is like above 590, which means that both leg actually expire worthless. So your premium, you collected 500, but you're also losing 350. So no matter how, the max premium you could collect is 150. Okay, that's how you actually decode a spread. You look at the difference between the strike price first, where you buy, where you sell, then you add back your premium, then that's your max risk. Okay, this is how you actually calculate it. But if you are asking me, do I have to remember all these formula to see the max risk? No, the platform already do it for you. Okay, the platform already did it for you, so you don't have to worry about it. Okay, about the max risk things. Okay. Okay. If let's say you guys understand, please tap one. Let me know you guys understand all these terms: the spread width, the max risk, the max profit, the ROI, these things. Buy here, sell here. Tap one if you guys can follow. Okay, I see some interesting question. What if the price drop between the short leg and the long leg expire? Okay, this is a very good question. Okay, I saw Kevin Heng ask, what if the price drops between the short leg and the long leg, which means that it's like at the money situation. The short leg is in the money, this one out of the money, but it's just like one leg difference. Sadly, if let's say you get assigned already, this one cannot exercise, right? This one you just have to close your underlying to take the losses. Then this one you have to close at the current you have to close your long leg as well. The time, I think, if let's say is around if let's say you long 30 delta, if let's say the price went up already, this one will be valuable as well. So they have to close your long leg to actually realize the profit, and this one you have to take the loss from the underlying. But the problem is what? The problem is your risk won't be defined, because you have no idea where your underlying price will be closing at. And then you also have no idea where is your long leg put options will be closing at. Because like sometimes the IV is high, sometimes the IV is low, your extrinsic value affected your premium changes, your risk cannot be defined. Yeah, this is what we call the pin risk. The pin risk. Okay. So yeah, that's the problem. If that is the problem why, like, when you choose a wider strike, right? This is the problem will be we have to face. And then we have to be prepared, like if let's say that if that's the case happen. Okay. Right. I hope I do answer your questions, Kevin. Right. Okay. So let's look at the next one. Is the bear call spread. Okay. Just now is what neutral to bullish wheel. This one is the neutral to bearish wheel. Basically, if with how to decode the spread name? Bear. So that we are expecting the price go down or neutral. Okay, so that we have a neutral to bearish wheel. So what we are betting the price won't be rise above certain level. If let's say in this case we are betting the SPY won't rise above 610. If let's say we are betting the price won't rise above 610, so what we do, we sell a call that at the 610, then we collect $400 premium. Okay. During that time, maybe it's trading at $4, so they'll be collecting $400. And then we buy a higher strike. The further out of the money is one. Then we pay for like 280. We put it for 280. So this one minus this one, the max profit we could collect is like 120. So how we actually calculate the max loss? so that we eventually, if let's say both leg in the money, we short at 190, but we buy back at 615, so that we are what? We are what? We lose money, right? We lose on $5, right? $5 times 100, 500. But because we also got collect the premium, so that 500 you minus 120, so that eventually our max risk is like 380. We short at 610, but we buy back at 615. So this is the spread defined. Then you add back the premium, then you get this one. The ROI is about like 31% in this case. So there will be only two scenarios. If let's say the price didn't break above 610, both leg expire worthless, nothing to do with the strike price. We just focus on the premium. How much premium we collecting? 120. 120. Okay. So if let's say the both leg is in the money, it break above the 610 and both leg in the money is already. So you short at 610 and buy back at the 615. We take the losses and then we minus the 120 credit. Then our loss is 380. Okay. The collateral, I want you guys to actually ignore because like the collateral is based on the volatility and different situations, so that it just like some of the example I just gave you guys. Okay. You still have to depends on the IV that times like your buying power to entry this kind of spread. Okay. All right. So you guys follow? If you guys follow, please type 1. Type 1 if you guys can follow. Very simple things like two spread. You guys can follow type 1. Okay. I want you guys to actually know that when you do a credit spread, then what you want to what kind of things that you need to understand. Okay. All right. So like and then what is the risk and the rules? This is the things lah. Like what if the SPY close exactly between your two legs on the expiration? Your long leg likely to be signed, but your long protection is expire worthless. But you might wake up with massive losses in your asset. And also before the expiration, if you didn't close your protection leg, which I assume that having the profit, then then the option expire worthless, you're likely to be losing a lot of money. It becomes like your naked option risk, unlimited risk already. So that it's not a set and forget strategy. You still have to monitor by the expirations and along the ways. If let's say the price already went deep in the money already, that's where you need to be aware. Okay, this way you need to be aware like whether you want to close your position if it's still lower than your max loss, or if you get early assign already, you have to make sure that you close your underlying price, close your underlying position that you got assigned, and close your long leg protection so that your loss can be minimized. Okay. You guys understand what I'm saying, right? Okay, if let's say understand, type yes. Okay, this is the pin risk. Okay, it's not a set and forget strategy. Okay, you have to monitor one. Right. So, an early exercise assignment risk. If let's say you are doing an American option because they can, you went early. Just now I already mentioned it went deep in the money. Then your trade, you have to manage your trade lah. Sadly, if like both leg is in the money, then it's easy because like your long leg you can exercise, then you just net off the position. But if let's say your long leg is out of money, that one is the most headache one. Okay, that one is the most headache one. Later I show you how. Okay, on the visualize. So the whole chapter summary is that always define your risk before you trade. You trade probability, not predictions. If let's say you have a predictions, you also have to be mindful of your probability will be getting higher. If let's say you have a very strong thesis and outlook. And also it keeps your capital flexible, and you can actually exit earlier if let's say you think that your thesis already reach your target and also fulfill your outlook already, then you can take the profit, because like sometimes it can change very fast one sometimes. Okay, so don't if so keep disciplined. If let's say your thesis already ended, you just close your position. So you need to think like an insurance, not a traders. Okay, but this one actually is not really that important, but because it can be both ways as well. Okay, so I'm going to do some platform demonstrations. Okay, platform demonstration, so that make sure for those who just join our first time join our live, make sure you actually follow and like our option playbook pages. We cover the fundamental actionable strategy and some platform tutorial, some market relevant insight. So then make sure you follow the option playbook. So if you guys are ready to go into the platform demonstrations, type one, so that I'll be knowing that you guys are done with this theory part. Okay, I saw some says like I don't understand. No worries. I'll explain with the platform with you. Okay. Okay. Let me see. Okay. Here. Right. You guys can see my screen. Like it's a simulator. Can you guys see my screen? Like the platform. You guys can see, right? Right. If you guys can see, please give me a yes. Oh, okay. All right. All right. Okay. So it doesn't fix on one tab. Okay. So what we need to do is that just now I forgot what mentions one thing. Just now I forgot to mention one thing is that this one, because we're trading early assignment risk only happens on American style options. But if let's say you are doing European options, right? There's no early assignment, because like a European option only can be assigned at the end of the at the expiration date. And the best part is that it's cash settlement. You don't have to worry about those like P&L, those assignment dates. This is why a lot of people they love to trade SPX, because it's an index and it's a cash settlement, you know. So they love to trade the spread in the SPX because it's the cash settle. Okay, right. So like for the sake of the example, let's go into SPX lah, maybe. Okay, let's go with stock first. Okay, let's look at the media. Okay, so once you press on the NVIDIA's already, you know that you will be landed into this kind of the charting things. But in today's sections, we are going to cover credit spread. So how we actually can conduct credit spread. Okay, first thing first, we need to choose our expirations. Like do things that we already conduct our analysis. I think it will be going for education purpose only. I think it will be going bullish, and then it won't break below 210 within 8 days, maybe 210. So if let's say we are bullish, so that we are doing what spread? We are doing a bull put spread. So 210 is here. I think within 8 days it won't break below 210. Then I will be selling this option. So this one, first thing first, I tap on the options. Then this one I press on sell. Sell this one first. Okay. Hold on a second. Before that, make sure you guys actually go to custom. Okay. Much more easy. So you tap on the 210. Then this one we do sell. We scroll down. Then we choose the strike that we think that it will be as our protections. Maybe we do. I couldn't. Oh, I can do that. Yeah. maybe 207.5. Okay. So the width is about like $2.5. Maybe I want to do a $5 width. Okay. Maybe we do this one. Okay. So that let's look at this the whole thing. So that now we think that it won't break below it's like 210 put. And we think we buy a 205 as our protections. So that what happened now is that our max loss is about 356.5 and our max profit is at 143.5. To address just now, I think there's one fellow saying that the pin risk, they don't understand the pin risk things, is that if this option, sorry, if the 210 option at the expiration, it went in the money, already, but your 205 still out of the money. You can, because it's still out of the money, you cannot exercise your option. You can't exercise your options. But these options is in the money already. So that during this time, you may need to consider to close your position unless that you think that it will this 210 that it already in the money will be going back into out of the money. Okay. If not, if you think that it will just keep on go deeper in the money, you may consider to close both of the position. The worst part is that this one in the money already, you got early assigned. So in your portfolio, you will be having Nvidia buying at 210. So you want to net off your position by exercising to sell at 205. You can't because like 205 is out of the money. But during that times, your 205 strike likely to be trading around at the money here. So that it may potentially profiting. So that what you can do is that you go to your account there and then you close your Nvidia position. And then you also close your long leg position so that you can minimize the losses. Okay. Because your long leg is not in the money. This is what we call the pin risk. If both in the money, then it's easy because you can early. If this got early assigned already, you can exercise your long leg because it's in the money already. Okay. All right. I hope I do answer your questions regarding the pin risk. Okay, let's carry on. So, like we're selling a 210, we think that it won't fall below this level, and then we bought the protections. Because just if we don't buy the protections, right, the max loss can be very scary, right? Because like these P&L, they assumes that we take the stock. If let's say the stock went to zero, this is what we can lose. But if let's say we are doing this, we're buying another leg, so it becomes 356.5 already, your max loss. And your max profit will be 143.5. So what we can do is we need to visualize. So because the market haven't opened, so the current price is like at the closing price is like 214.75. So that what you can do is you can scroll it around. If let's say by today the price went up and how you can see the right side, the current P&L is keep moving, you can actually visualize to see how much is the potentially profit you could be making. If let's say today it rise, if let's say today it goes below, how much you could lose. Okay. And also if let's say the price at the expiration, the price landed at this area, then you should be able to collect the full premium of 143.5. Okay, 143.5. If let's say it goes down slightly, you'll be still profiting, but you have to, in this area, you have to handle the assignment. Likely your short leg will be assigned, and then you have to close your long leg and you close your underlying prices. Okay. This one already calculated for you. Depends on which prices which underlying prices landed. Okay, so that once you have everything's done ready, then you just press trade and then you just move on to the to the to the to the to the next trade. Okay, and then when you trade, right, make sure that you get the fair prices. Like usually, I would just go for the mid prices. Okay, right. So far, so good. Okay, let me look at the chat box. Mean assign the sold put and then also exercise the bought put. Yes, yes, yes. You have to do that. But if let's say you're doing SPX, you don't have to do that. It's automatically cash settle one. It's automatically cash settle one. Okay. But sometimes if let's say you didn't get assigned by the expiration, both leg in the money already, they will just one trigger auto assign, one trigger auto exercise, so it will control each other. But if let's say that doesn't happen, you have to like be aware manually to actually exercise it lah, I would say. If let's say sudden, but the problem always is like early assignment. Then what? Then your action is that what you need to do with the long leg. If it's in the money, then you just exercise. If it's not in the money, then you just close your long leg and close your underlying position. Okay, that's how it works. Okay, so yeah, when you have those kind of position, let me see this account. I'll show you this account. Okay, do we have position in this account? Let me see. Okay, I'll go. So if let's say we put on the spread, then you actually can put the trade. I forgot this password already, but it's fine. So that's basically how you actually do it. Because so if let's say that you guys want to like do the SPX, let's look at the SPX. If let's say we expecting the price doesn't break above, it won't break above maybe 7,600. So let's see, 7,600 for 0 DTE. So we do one sell, we do one buy. Have to go to a custom. We do one sell, do one buy. Sell 6,700 and buy another thing. So how much premium we are getting? $15 only. This is very far out of the money. Sometimes you have to think whether it's worth it or not. Like, but this one I think is like having higher probability because the price is already here. So the price have to like go above this level. You only can lose money. So it depends on how you're actually managing it. You know? If let's say, how do I actually get this? Okay. So if you guys are asking how to actually pick up delta things, right? First of all, let's remove this. Then, if let's say we are referring delta, this is the delta that I'm talking about. Like delta. And then, if let's say just now the delta is 30%, which means that there will be this strike price currently have a probability of like 68% of the probability it won't go in the money. So if let's say 7,600, there's around like 95% of the probability it won't get in the money. Okay. Doesn't mean it won't get in the money, just that currently you look at this number, it is saying is that there will be 95% of the probability it won't get it in the money. If let's say I'm willing to take more risk, then like 30% maybe. So 30 delta, then I buy another 7,574. 358, then I'll be collecting like 115. Eventually it will be cash settled. Depends on where the price is. Like, even though you landed here, it will be cash settled as well. So I don't have to worry because it's a cash settlement things. So you just move around. Yeah. I expecting the price to go bearish and the neutral. Neutral, if let's say it's sideways here, I make eventually after expire, I make 120. Let's say go further below, much more favor me. But if let's say go too much above, then I'll be losing money. So why choose custom instead of vertical spread? I love to adjust myself. Like you can actually choose like the vertical the one. Like it's very packed this one. You can actually like go to vertical, so that it will combine. You will combine. Then you have to like adjust accordingly because like this one is like how what is the width of it? Default. Let's do a if let's say there's a $5 width, you see 7550, 7555, the $5 width. So that you have to keep on adjusting your width, this kind of to do this. But I I prefer to do custom because I can pull it around. Say for example, it's like if let's say I'm doing this right, like a cell leg, I can actually pull this. Not sure why the PC version cannot, but by right, this one can be pull it around. I could pull this up and down and all those kind of things. But usually when I trade the options, right, I love to use the desktop version. Like desktop version is here. If I'm doing SPX, then if I'm looking at the vertical, right, you see I have to like look at these kind of a number of things. And then if I'm doing the sell, then I have to like if let's say I want to adjust the long leg, then I have to like calculate myself those spread with those things. Maybe the width is like I just want a $5 width. Then I have to pick it up again and sell, and then it become a combination. But if let's say for custom, right, I can pick this one, sell. I can pick this one, long. I can move around. I can move around to see the changes of the P&L. You see? Let's say the $5 Y is like that. If let's say I want to pull it more probability, then I get this one. The best part is that on the desktop, you can actually adjust. You go to the curve here, then you adjust accordingly. You see the P&L changes. You see how is the P&L changes. Also, if let's say I want to close the whole position after maybe this one is 0 DT after 4 hours. If it stay above this level, then I expected to be profiting at $229. Okay. So this is why I love to use custom, because sometimes right I will be doing some weird things like I do this and then I also sell another leg to collect more premium. If let's say I assume this one have a higher probability, so I do this kind of thing. But I collect more premium, but I take more risk sometimes. And then sometimes if I'm trading a very directional or earnings trade, I love to do this kind of thing. 3 contract, and then long 2 contract here. Sometimes I do this thing, then I adjust accordingly. Sometimes I adjust accordingly. Like if let's say the price, I assume it will land it at this area, then I take my best profit. If let's say go too beyond, I make less. And then how is the P&L change? Sometimes I do this kind of thing, custom. I already get used to it, but if let's say you guys I'm just a beginner, then you can do this kind of thing. But of course, if let's say some of the people use this as reference as well, the expected move. If let's say I already told you guys like the expected move already input into this level, so like you can actually, if let's say the price for 0 DTE expecting it will having a 68% of the probability it will landed within this level, so maybe some people will be just sell here and buy here. If let's say they want a more probability, they can pull it further away. Okay, but the more further out of the money you put, the lesser the premium you will be collecting. but your strike, because it's like very fixed already, so that likely you get your max loss won't be changing that much. But if let's say you get to collect more premium, you'll get the 400, so your max loss will be 400 and 100 at this level. You know? So may I ask, like, what caused the difference in the simulator where the current P&L negative? Because you have to like be mindful of few things. One is like the P&L here. Another one is that the P&L, the current P&L. So if let's say I'm focusing on the current P&L, if let's say I'm entering into this position, the price like traveling around this area after like few hours, the P&L can be changed according to different factor. Some is like time factor. Let's take a look at the other further expiration, like 7 days. If let's say 7 days, I'm doing this like 375, 125. Then the price, if let's say traveling around this area, assuming there's 7590, then assuming to be making around like 5024. But if let's say the time passed by already, so I could be making more because like the time passed by if the data that favor me, but suddenly the IV suddenly increase already. You can see the P&L change. You know, this is how you actually simulate the situations. But if let's say by the end of the expiration, it stay at this level, so both leg will be expired worthless. So that no matter how you'll be collecting 125. Okay, 125. So this is how you actually analyze it. And then some why your P&L is changes because changes are not really aligning, because it's not saying that this simulator is the most accurate, because this is just a theoretical P&L. Eventually, like you still have to depend on your current prices, because like sometimes the current prices, if it gets further deep out of the money's already, right? Or maybe in the money, further deeper in the money's already, right? The spread can be widened. If the spread widens uh in a very very bad way, your P&L can be very horrible one, because like the spread very wide. The spread very wide. Then sometimes it's like here it's like $1, $2 like that. So they make sure, that's why I say it's like in the beginnings, liquidity is always the first priority when you want to trade the underlyings. Even though you get the curve correctly, eventually if you see those underlying those options getting deep in the monies already, the spread becomes very wide. You better avoid it. Okay. All right. So like let me see like if some, not sure whether I can find some illiquid. This one liquid. Like maybe liquid. Sure, I'm just simplifying. You see, like this kind of stock, right? You think that 0.12, 0.9, or that, so that you do this. But if let's say you are doing a bull call, for example, you're doing a bull put, sorry, so a bear put, sorry, bear put. If let's say you're getting deeper in the money already, sometimes your P&L can be very weird one, because your spread is very wide. You see, it's very wide. This is even worse, 85 cents to $1.50. How you want to close? You want to close at what price? Your risk can your current P&L can't be didn't factor this spread, because the spread during the time could be very wide. Your P&L can be changed. Okay, because like the P&L, I think it's like the live one that we are looking at, likely to be mid price. If let's say we are referring to the mid price, the mid price of, let's look at this one. The mid price of this 6.5, 1.59. So that, and then you assumes that you can close at what, like 190? No, the current highest bid is the 127, and you want to close it at 159, which is uh a bit hard, so sometimes your P&L, the P&L curve, is very tough to actually like simulate the things because it's spread very wide. Make sure you trade those liquid underlyings, and then if you don't want to bother with those early assignment things, like you maybe you find some cash settle European options to actually trade with it. No, but does that mean stock cannot be traded? No, stock sometimes you can, because the SPX is like $5 with. This one sometimes can get $2.5 with, so that your max loss sometimes can be very minus one, like 200 something. Just now it's like minimum, no matter how we go, it's like 400 for XPX. If let's say we go to SPY, let's see. SPY is $1 if I'm not mistaken. Is it $1? So if let's say I'm doing this and then I'm doing this, 59.41. You see? So it depends on your account size and your trading thesis and your underlyings as well. So yeah, that's the whole sections about the credit spread. Like, I mean, and then also make sure that you look at the curve. If let's say you are doing a bull put, then you as your P&L curve should be looking at like this. As the price goes up, then you'll be making profit. But if let's say you are bearish to neutral, then what you can do is that you can go to the call side, you sell one by one. Okay, so this is how it actually works. But if let's say you want to widen your profit, then you can increase your profit, then you can do this. But your max loss also will be coming up. And also, if you're doing this, widen your spread, you having a higher probability of pin risk. This one in the money, this one out of the money. So be mindful of that. So if let's say you want to see like if this one in the money, this one out of the money, then what is the P&L will be eventually? You can actually look at here. I think it will be roughly here. The slope, $70 profit, or maybe like $34 something like that. The slope, roughly around this area. But if let's say the spread very wide, that's a different story. Okay. All right. Okay. Okay. So let's move back to the things. Not sure whether I can find the feature for you. The feature again. Or the funds. Where is the icon? Sorry, hold on a second. If let's say you guys want to like, where is it again? Yeah. If you guys go to the accounts and then you click it, or you find those icons, you want to early exercise your option, you can go here. Then you tap on the option exercise. So it will shows you. So far this account doesn't have. If it will definitely show you like if let's say you have an option in the money already, the long leg, it will appear here. Then you can exercise here. But if you didn't, if you didn't have the sometimes you want to exercise your long leg, but you don't have the sufficient amount of money, you actually can email to the dealer, the Moomoo MY dealer, to actually ask them to exercise this option, because this one is given that the conditions that you have the buying power or have the cash to actually conduct this early exercise. Sometimes because we do spread, we don't have the sufficient amount to actually buy the stock. That's why we do spread, right? But this one, because it's a single leg, it assumes that we already have the money. you cannot, sometimes it's not allowed to you to like exercise your option to net off. So what you can do like during that time is that you just email to our Moomoo and Y dealer email. You saying that you just you just show your ticker symbol, write down your ticker symbol. You just say that you want to exercise this option, so that the dealer will be helping you to actually like exercise it. Okay. So don't worry when you want to exercise this option, but you fail because you doesn't have sufficient buying power. You could just email to the Moomoo and Y dealer to actually exercise it. Okay. So this is what when trading the American options, what we need to like deal with, you know, right? So yeah, so that's I think that's the whole ideas of the credit spread. You guys, I hope you guys do enjoy the whole sections because we already at the chapter 7. So if you guys do learn something, please type 1. So if let's say not understand, you just type 2 so that and then you ask the questions like which part you don't understand. Yeah, see a lot one coming. So yeah, glad that I did my job. Okay. Right. So like that's basically the credit spread. You guys can actually practice with it with your phone. And best if let's say if can, you guys just download the desktop. It's really amazing desktop features. Now even have this strategy labs and the curve. Sometimes you can use this as well, you know. Like this one is the one standard deviation based on color volatility. How much is the price expect to be in the money. If let's say I could put at like this level, then there will be 97.62%. It will be below 780. No, this probability things. 100% it will be below like 816, of course. So I can use this to actually see how much probability the price will be staying below this level or above this level. Like you see, the lower it is, 100% it will stay above 695. You guys actually can use more of this. If let's say you guys want to see one standard deviation, this is it. Two standard deviation, three standard deviation. You actually can use this price to justify your strike if you want. And also, if let's say you guys remember check the IV. When the IV is high, it's best it also favor your strike as well because like if I hit the price is now the IV goes down, then you fasten your profit, you know, right? So try to install, you know, like install, and you get those probability things. You learn by looking at it. Now the best is like if you train the directional things, you even have a Jax gamma exposure, you know. So, but it's not covered in within my option playbook series. Okay, so if you guys okay, then I hope then I'll be ending my sections. I thank you for joining tonight, spending your time to actually join my sections. So we already reached at chapter 7 already. We still have 3 chapter left. After the 3 chapter, then I'll be saying a goodbye to you guys. You know, like you know, thank you guys for following us along the way. I hope you guys do learn something and then is yeah. Thank you guys. Thank you. So I'll be ending my sections now. So yeah, if you guys didn't manage to watch the full video, you guys can watch it uh uh after the session. There will be a replay button for you guys, you know. And then also make sure that you stay tuned for the Alvin sections. He will be sharing a lot of the amazing tools and the features and the strategy to you guys. Especially he has a price framework that he loves to use. Make sure you guys follow him as well. Okay. So thank you guys for following. I'll see you guys in the next chapter. Goodbye.